Hello everyone, newborn investor here and welcome to another video. Today we're going to talk about Opendoor's recent announcement to go public through a merger with Capital Hedosophia. So if you're interested, make sure to stick around as we're starting right now. Since its founding in 2014, Opendoor has redefined real estate transactions. They provide a great online platform where property owners bid to sell their properties. When a bid is accepted, Opendoor purchases the property as it is, makes improvements or does necessary repairs, and then relists the property for sale. For home sellers, Opendoor offers to eliminate all of the hassle and uncertainty of selling a house with a simple, transparent offer, and for this service, Opendoor charges a fee which is slightly higher than the commissions charged by real estate agents. Opendoor also makes money from any difference between the acquisition cost and the selling price. Till date, Opendoor has served over 80,000 customers and sold over $10 billion worth of homes. In 2019, the company sold more than 18,000 homes, generating $4.7 billion in revenue. By the way, if you like the video and find it valuable, make sure to hit the like and subscribe button as it keeps me motivated to put in the long hours for making these videos. Alright, let's move on. Funding history. Opendoor has participated in 9 rounds of funding so far, and in total they have raised $1.5 billion. The last funding round for Opendoor was back in March 2019 for a total of $300 million. On Tuesday, Opendoor announced its plan to become a publicly traded company through a merger with a blank check company, Capital Hedosophia. You heard it right, blank check company. So what are they? Blank check company or SPACs. Blank check companies are otherwise called SPACs. SPAC stands for Special Purpose Acquisition Company. These companies act as shell companies and they don't have any operations. The sole purpose of SPACs is to acquire other companies within a time frame, and that is normally within 2 years. When a SPAC goes public, the money raised from the IPO is placed in a trust account until an acquisition is made or the predetermined time period expires. If a SPAC announces a merger and for some reason the merger is not complete within the specified time, the money held in the trust goes back to the shareholders, and this is minus any management fees or expenses. Simply put, SPAC raises capital from investors and uses it to acquire other businesses. After the initial IPO, all SPACs go through a searching phase where they are in the lookout for companies to acquire. During this phase, SPACs will be trading mostly around the IPO price, and this price is based on the cash that SPACs have in their trust account. When the merger is completed, the new company would change the SPAC ticker symbol and adopt a new ticker symbol. So why SPACs and not traditional IPOs? SPACs offer many advantages, so let's look at a few. Shorter process duration. While traditional IPOs can take several years to implement, SPAC combinations take on average 6 to 8 months to complete once a merger agreement has been reached. Available funds. SPACs can immediately offer financial support to the newly acquired business. In a SPAC, the funds are already raised, and by completing the merger, the target company gets access to the capital raised and can use it to grow their business much quickly. Lower cost. Traditional IPOs are much costlier than SPAC transactions. The SPAC takes care of a significant portion of the underwriting fees at the time of the SPAC IPO. Post-merger, the combined company may have to pay additional underwriting fees based on the IPO size. But when you compare it against a traditional IPO, this cost is much lower. Merger with Capital Hedosophia. Last week, Opendoor announced its plan to become a publicly traded company through a merger with Capital Hedosophia, ticker IPOB. Capital Hedosophia Holdings is a partnership between Chamath Palihapitiya, the founder and managing partner of Social Capital, and Ian Osborne, co-founder and the current CEO of Hedosophia. The management team of Capital Hedosophia has great relationships with founders of leading technology companies, venture capitalists, and growth equity fund managers. This gives them a competitive advantage in pursuing a broad range of opportunities. Prior to Opendoor deal, Capital Hedosophia under ticker IPOA completed a successful merger with Virgin Galactic. Clearly, the management team knows what they're doing and has a good amount of experience in SPACs. Now, speaking about the deal, Social Capital filed Form 8K with SEC, which defines the terms of the merger. The deal values Opendoor at $4.8 billion and is expected to provide up to $1 billion in cash, which includes $414 million of cash held in the trust account of Social Capital and a fully committed private investment in public equity or PIPE of $600 million. So what's my take on the merger? When you invest in a SPAC IPO, basically you are investing in the management team. Once a merger is announced and if it's viewed by investors as a great deal, SPACs are definitely going to trade higher. I consider purchasing SPAC IPOs to be speculative. We bet on the management team and their ability to find and close attractive deals. Remember, SPAC alone does not have any operations to generate income. They become a sound investment only if the merger is completed and the resulting company adds value, which translates to more earnings. We have seen some great examples of successful SPAC mergers like Virgin Galactic, DraftKings, Repay, and others. In the case of IPOB, it is merging with Opendoor, and buyers of IPOB could reap in some good profits. Since its initial public offering in June, IPOB is up over 35%, so investors who speculated and bought it at the IPO price of $10 are rewarded well. Once the merger completes, they may see their investment grow even higher based on how the market perceives Opendoor's business. One thing that stands out to me is the Opendoor business model itself. Even though it's a market leader in its segment, Opendoor has stiff competition from major players like Zillow, Redfin, and others. These players do have a huge inventory of real estate listings and customer base, and they could easily incorporate Opendoor's business model. This would squeeze the margins out of Opendoor, and this would be a concern only if you are in for the long term. Now, I would love to hear from you guys. What do you think about Opendoor and its IPO? Leave a comment below with your answer and I will be sure to follow up with you. Also, if you liked this video and found it valuable, make sure to hit the like and subscribe button. I really appreciate your support as it keeps me motivated to put in the long hours for making these videos. So until you hear from me again, stay safe and thanks for watching. Bye.